Welcome to Mad Money. Today we're diving into the belly of the beast, folks. The heart of the action, the day the market goes haywire, Opex, or options expiration day. Now you might be thinking, Jim, options expire every Friday. What's the big deal? Let me tell you something. There's a whole lot more going on under the surface than meets the eye. If you're trading on gamma exposure using options flow data, you need to buckle up because Opex can make or break your portfolio. We're talking wild price swings, liquidity drying up faster than a puddle in the Sahara, and enough gamma flips to give you whiplash. Welcome to Mad Money. Today we're diving into why options expiration days, or Opex, are a minefield for gamma traders. If you're leveraging gamma exposure and options flow data, you need to hear this. Now, folks, you got to understand gamma. It's like the glue that holds the market together, especially in the days leading up to Opex. Market makers, those brave souls, they gobble up options contracts, and to hedge their exposure, they got to buy or sell the underlying stock. This creates a feedback loop, a virtuous cycle where rising prices beget more buying and falling prices, well, they trigger more selling. It's all hunky-dory until Opex hits, because on Opex, bam, the music stops. All those options contracts, they expire, they vanish into thin air, and with them goes the gamma, the glue that was holding everything together. Market makers, they don't need to hedge anymore, so they unwind their positions. And let me tell you, when they unwind, things can get ugly fast. We're talking about billions, trillions of dollars sloshing around, creating these massive price swings that can leave you feeling like you're on a roller coaster designed by a lunatic. This is where the real danger lies, folks. You see a stock up big, you think it's the real deal, you jump in and then wham, the gamma unwinds, the market makers pull the rug out from under you and you're left holding the bag. All right, man, now let's talk about pin risk, another landmine waiting to blow you up on Opex. You see, options, they have these things called strike prices. And when a stock price gets close to a strike price with a ton of open interest, market makers, they get nervous. They start hedging like crazy to avoid getting assigned on those options. This creates a sort of gravitational pull towards the strike price, pinning the stock in place. But here's the kicker, on Opex, you don't just have one strike price to worry about, you have a whole cluster of them, all bunched up together like a pack of wolves, ready to pounce. And when those options expire, all hell breaks loose. The stock can jump from one strike to the next, leaving a trail of carnage in its wake. It's like playing Russian roulette with your portfolio, folks. You might get lucky a few times, but eventually that pin is going to come loose and you're going to be left wondering what hit you. Now, you might think that with all this action going on, Opex would be a liquidity bonanza, right? Wrong. Sure, you'll see higher trading volume, but it's often deceptive. See, a lot of that volume is just noise, algorithms, and high-frequency traders trying to front-run the market makers to catch a falling knife to scalp a few pennies here and there. The problem is, all this noise, it creates these liquidity vacuums. You go to buy and there's no one there to sell. You go to sell and suddenly the bid disappears faster than a plate of cookies at a Weight Watchers meeting. And when liquidity dries up, folks, that's when the real panic sets in. You get these massive bid-ask spreads, slippage that can eat you alive, and before you know it, you're stuck in a trade you can't get out of. It's like being caught in quicksand. The more you struggle, the deeper you sink. Chapter 4, Volatility, Regime Shifts. Let's talk about volatility, baby. In the days leading up to Opex, you might notice things are relatively calm. That's because all that gamma hedging we talked about, it acts like a giant sponge, soaking up volatility. But don't let that fool you, folks. It's like a pressure cooker. The longer you keep the lid on, the more explosive the release. And on Opex, that lid blows sky high. All that pent-up volatility, it comes roaring back with a vengeance. We're talking about the VIX spiking, implied volatility going through the roof, and your options premiums, well, they can evaporate faster than a snowflake in hell. The problem is, most trading models, they're not equipped to handle these sudden shifts in volatility. They're like deer in headlights, caught completely off guard, and when the models break down, folks, that's when the real chaos begins. Now, here's where things get really interesting, folks. Remember how we talked about market makers being long gamma before Opex? Well, once those options expire, they flip the script. They go from being long gamma to short gamma. And let me tell you, that's a whole different ballgame. You see, being short gamma, it's like trying to catch a falling knife. The market moves against you, you've got to sell more, which pushes the market down further, forcing you to sell even more. It's a vicious cycle that can spiral out of control faster than a Tesla on autopilot, with Elon Musk tweeting from the driver's seat. And to make matters worse, all that options flow data you were relying on, well, it becomes about as useful as a screen door on a submarine. The dynamics of the market have completely changed, and if you're not careful, you're going to get caught on the wrong side of the trade. Now, let's not forget about the other players in the market, folks. We're not just talking about a bunch of individual investors like you and me. We're talking about hedge funds, institutions, these big players with deep pockets and even deeper algorithms. And guess what? They know all about Opex. They know how the game is played. So what do? They try to front-run the market makers. They try to anticipate the gamma unwind, the pin risk, the liquidity crunch. And when you get a bunch of these big players all moving in the same direction, it creates this self-fulfilling prophecy, a reflexive loop where the market moves, not because of fundamentals, but because of the sheer weight of money behind it. It's like a herd of buffalo, folks. Once they start running, you better get out of the way, or you're gonna get trampled. Finally, folks, let's not forget about the practical realities of trading on Opex. This is when the rubber meets the road, when all those fancy algorithms and high-speed connections are put to the test. And let me tell you, things can go wrong, and they often do. You get order executions, you get latency in your data feeds, you get margin calls coming out of left field. It's enough to make your head spin, and if you're not careful, these operational glitches can cost you big time. That's why, folks, on Opex, it's often best to just step aside, to let the dust settle, to live to trade another day. So there you have it, folks. Opex days are fraught with risks that can undermine your gamma trading strategies. It's often best to sit out and let the chaos resolve. Remember, folks, the market's not going anywhere. There will always be opportunities to make money, but on Opex, sometimes the smartest trade is no trade at all. Thanks for watching Mad Money, and remember, there's always a bull market somewhere.